Today we're going to talk about what is the difference between investing and speculation. Hi, my name is Gary Mishuris. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So a lot of times people say, "Oh, this is speculative," or "Well, this is really an investment, not a speculation." So what does it mean? And is one better than the other? Well, I think one is, and I think that if you care about not losing your money, and you should, you really should be making investments as opposed to speculating. And a lot of times there are definitions that are flying around where it's not clear, how robust it is. So let's go back to Benjamin Graham, the father of value investing and the author of Security Analysis, and let's take a look at his definition and what we can learn from that. So Graham, in Security Analysis, defined investing as follows. So pay careful attention here. An investment operation is one which, upon thorough analysis, promises both safety of principal and an adequate return. So I think that there are four important components to his definition. First of all, he talks about an investment operation. I don't think that's an accident. He doesn't say an investment is something. He defines an investment operation. And I think it's because in his mind, it's not, it's very hard for one individual investment, be it a stock or bond or whatever, to really be of such sufficient safety as to meet the criteria for an investment. So he really talks about an investment operation, which is a process, which means diversification both at a point in time, so at a given time you own many different investments or some number, and also over time. So an investment operation is your process of investing that can be judged as either speculative or meeting the definition of an investment. So thorough analysis is probably the least controversial, although it's obviously subjective. So there is no one quantitative way to say what thorough is, but it certainly needs to address the key characteristics of the business, both qualitatively and quantitatively, to, in my mind, meet the test of thorough. So looking at a stock chart and saying, "Oh, stock went up or went down," or that's not thorough. Neither is looking up some metrics like saying like the price to earnings ratio is such and such, therefore this is a good investment. That's not thorough either. You need to understand the business both from a financial point of view and from a qualitative point of view in order to have some intelligent opinion of what that is worth in the private market or what the intrinsic value is. And the last two terms are also kind of hard to understand a little bit. On the surface, says promises safety of principal. Well, what does that mean? That means is you can never lose money ever. Well, if that's the case, you probably would only buy treasury bills, and even that you might be a little bit worried about the government doing something strange. So there must be some level, some threshold where if Martians land on Earth, all bets are off. But you have to have some level where, in the aggregate, you're extremely unlikely to permanently lose capital. Which, by the way, is a different criteria than saying, well, your portfolio can't decline in terms of its market value in 6 months. In the short term, the market can price your securities whatever it wants. But if you're right in your thorough analysis and your valuation work, what Graham is telling us that you should have very, very low chances of losing principal over time. And finally, satisfactory return. So, what's satisfactory? Whatever you like. Is it 20%? Is it 3%? He doesn't give a number, right? And I think that's intentional because I think it's relative to your opportunity cost, but also it's relative to your likely opportunity cost over time. So right now, as I'm saying these words at the end of 2019, the investment returns offered by most assets are fairly low. So U.S. Treasury bonds are offering less than 2% for 10-year bonds. So on a relative basis, you might say, well, if I do better than that, maybe that's satisfactory. And I would argue that that's a low bar. I think historically you have been able to make 6 to 7% plus inflation in U.S. equities as an example. So I don't think you should settle for something that seems relatively attractive at the point in time if it's low in absolute terms. So personally, I don't intentionally make investments unless I think I can get a pre-tax return, nominal terms, of at least 12%. That's not to say that every investment I make will make that return, because I'm going to make mistakes. I'm human. Investing is a batting average business. However, I don't intentionally make investments that promising annual rates of return below that. What that should be for you, you should figure out, but you should have a mental threshold and an understanding of why you're picking the threshold. So just to review, an investment operation is one which upon thorough analysis promises both safety of principal and an adequate return, you really should understand those four things. The investment operation part, what's your process? Thorough analysis, how do you assess individual investments? Safety of principal, so how do you guard against large permanent capital losses? And the satisfactory return is how do you make sure you make an attractive return for your time. If you like this video, please hit like and also subscribe to my YouTube channel where I post educational investing videos on a regular basis. Thank you.